Hey traders, this is Blake Morrow with Trader Summit, and I have Mr. Jim Welsh with Macro Tides. He's back with us every Friday, talk about this kind of choppy market that we've had. But Jim, I mean, what are you making of this whole move that we've seen this week?
Okay. Well, again, my take was we were looking for a pullback. I was looking for treasury yields to move higher, as you well know. I was looking for gold to pull back as the dollar strengthened. All that has come kind of unfolded. The dollar had a little pullback. I think there might be one more tick up on the dollar. So if I'm right, the dollar's entering a phase where it may pull back, and it's all predicated on, for months when we talked, Wall Street kept doubting what the Fed was going to do. The Fed says, hey, we're going to put the funds rate up to 5.1 at the December meeting. And Wall Street was, no, they're not going up there. In fact, they're going to be cutting rates the second half of this year. So what we've seen, all the doubting Thomas, is now all of a sudden Fed funds futures are at 540 and no cuts this year.
And let me just say, Jim, you've been on the forefront of this. I'm going to give you kudos for this. And sometimes I'll lean into you and say, well, Jim, you said this and this didn't happen, but you've been really ahead of the curve saying people are not listening. These economists are not listening to what the Fed tells you that that rates are going to stay higher. And now the market is bending, right?
Yes. Okay. And almost kind of going the other way.
Yeah.
And part of this was driven not so much by Fed talk. It really wasn't, Blake, because the street interpreted Powell on February 1st as being dovish. It's like, really? But so that stuff still happened. But what made the difference was the employment report, the retail sales, the ISM services number, and then obviously the inflation numbers, which again, I wrote about in February 1st, my macro tides, that I think we're going to see inflation tick up for the month of January, which is going to kind of derail, the mindset. So all those things combined has gotten the street to like, oh, wait a second, they're really going to do this, 540, they're going to hold it there. I just think the pendulum in the short term may have swung too much to the hawkishness by the street, and that the employment report in January is up 500,000. It's going to be in February, it's going to be 200,000 plus or minus some number. Retail sales up 3%. Is that going to be up 3%? No. So I just think that potential, and then finally the inflation number, the CPI was up, I think 0.5 or something month over month. I just think we're going to see the CPI drop from 6.4 to maybe 6.1. So the point being,
but Jim, and I get what you're saying, but isn't everybody else thinking the same thing? So I guess the question would be, expectations are going to come down. Let's just, you look at CPI. Let's say CPI expectations come down. The question is, are we going to beat it again with the lowered expectations, or are the numbers going to start coming in worse than expectations moving forward? What do you think?
Okay, when you say worse, which worse are you talking about?
Worse meaning just less robust.
Okay.
Inflation comes in cooler than analyst expectations.
That is going to happen. I've been writing about this really since last October, that we were going to see a very large drop in inflation. I thought there'd be an uptick in January, and guess what? In the next 5 months, we're going to see another fairly large drop in the CPI. And the reason why I know this is the CPI is a 12-month rate of change. So you go back to the numbers for February through June of 2022, and you say, okay, well, what are we taking off? And we're taking off 4.6% off the CPI. So if it's up 0.3% each month, that's 1.5. That means the CPI is going to drop by 3.1 or 4.1. So it's going from 6.4 down to 3.2. If the CPI is up 0.4, you're still going to subtract to 260. So the takeaway values are so large, we're going to see that come down. And that's true for all the inflation numbers, obviously, because they were all high last year from that February to June time period. So I have no doubt that the inflation numbers are going to come down. And, again, I think Wall Street's overemphasizing inflation, but to that extent that they didn't see the uptick in January coming, and all of a sudden it's, oh my God, it's going to be more sticky. My Fed. That's what's driven the Fed funds futures to go where they are. My point is, I believe that we're going to see softer employment numbers. The CPI is going to drop from 6.4 to 6.1, maybe even 6.0, possibly. And as that happens, I think you're going to get the same stupid mentality that's been operating for the last year. Oh, this means the Fed doesn't, in other words, the pendulum went too far to, oh my God, the Fed is going to get really serious. And well, maybe they won't have to go serious. I mean, they're even talking, I think it's about a 30% probability that the Fed will go 50 basis points at the March 22nd meeting. And this is what really this culminates. I think the data points are going to come in that make people think, whoo, I don't think they're going 50 basis points. They're only going to go 25. That's a relief. And I think if that all unfolds, the dollar's going to pull back and everything that's been operating opposite to the dollar is going to rally. That means treasury yields come down, stocks rally, go.
Well, we're going to go into all your charts and what you think the markets are going to do moving forward. But let's start off with this week. And because this week we got a lot of Fed talk, and markets actually were moving and listening. Now it's like now they're paying attention to Fed speakers. Yeah. But Jim, are they actually listening to the right people? That's the question, because you brought this chart and it's like, wow. Okay. So Bostic says I forget the comments because I don't follow him quite as closely as you.
Well, he said he's in favor of 25 instead of 50, which is why the market rallied yesterday.
Yeah. There we go.
Last week you had Mester and Bullard said, we were in favor of going 50 at the February 1st meeting. Oh no. Oh my goodness. Right. So you can't tell the players without a scorecard. And the point being is, the people that are on the board, Powell, Barr, Waller, blah, 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 the rest of them. Okay, there's going to be a nominee to replace Brainerd soon, but those guys get to vote every time. The New York Fed, John Williams, gets to vote every time. So the New York Fed is like the first among equals. And then the other four rotate. And so what you can see is Mester and Bullard don't vote. Bostic doesn't vote. Are they going to express their views and opinions? Absolutely. Will some of these people listen to them? Absolutely. Bullard carries a fair amount of weight. I think Meister is respected. But the point is, when the push comes to shove, you got to look at who's going to vote. And as I've written about the last couple of weeks, at the February 1st meeting, you had some people wanted to go 50, but they went 25. And I think the argument again goes back to, we don't want to make the mistake of the 1970s by raising rates too aggressively that tips the economy into recession, that forces us to reverse course before inflation is really wrung out of the system. So to me, that logic is what's going to dominate. But I think there's a trade-off. What we're like at the December meeting, they increased the target rate from 4.6 on the funds rate to 5.1. So I think the trade-off here is only 25 basis points at the March 22nd meeting, but they're going to raise the dots again from 5.1 to 5.4, maybe a touch more. I don't know, but so it's a concession. It's like, okay, these people got together. Some were in favor of 50, others wanted 25, but those is 25 said, you know what? Let's raise our target to convey that we're still serious. Just because we did 25, not 50, doesn't mean we're relenting in any way. But if I'm right, how are the markets going to react? I mean, the majority of people don't pay attention to this stuff or don't understand it. And they've shown that repeatedly over the last year in terms of looking at the Fed pivoting last fall. I mean, it was never going to happen. So anyway, I just think that sets up the markets for a pop. Again, another, I believe, a misinterpretation of the bigger picture. I still think we're going to see a decided slowdown as we get to mid-year and beyond, and potentially a recession based on inverted yield curve, leading economic indicators, money supply contracting is not a plus, and also the increase in lending standards in the third and fourth quarter. I mean, the banks are actually starting to choke off liquidity. You wanted that loan? Sorry, we're not making that loan. Oh, you want that loan? Okay, you're gonna pay an extra 50 bips to get it. So anyway, I just think this is the classic head fake. Last summer, oh my God, we're in a recession 2 quarters in a row, and the Fed's raising 75, and now, we don't have to worry about a recession after the January data. It's perfect in terms of a setup for, oh my goodness, things are really starting to slow down. Again, I'm projecting a few months. Yeah. And then earnings get cut, PE gets contracted. So to me, it's a setup psychologically for the market. And again, it's all predicated on the majority of people just have a very superficial understanding of monetary policy and where these people are at and what they're trying to accomplish. A 40-year high in inflation. Powell called it a severe threat. He's repeatedly, and other members too, have said, we're going to finish the job. And we're going to risk a recession by maybe potentially holding the funds rate at that high level longer. So they're committed. And I just think that commitment is ultimately going to cause a very meaningful slowdown in the economy.
Well, okay. So let's then talk about your next chart, which is yields, because yields have been, for all intents and purposes, they've just been ripping. And it's like it's like the stock market doesn't get the memo. I know you're saying the economy will slow down. I know we're going to get in the stock market too, but right now, you're looking at yields and what do you make of this move? And then why isn't the rest of the market paying attention? So,
okay. So back, again, on February 1st, you can see on the 2-year was that 404. The Fed had just raised the funds rate to 450, right? And they're saying we're going to 5.1, but Wall Street in its infinite wisdom was talking, oh, no, they're not going to do any of that. And then all of a sudden we started to get, the jobs report on February 3rd, the ISM survey on February 3rd, the CPI. Okay. So the idea that markets discount the future is just a bunch of baloney. It really is. And so now we're seeing, I believe, in the short term, an overreaction. The 2-year got above the 488 high back in November. My expectation was that that would pull up Treasury yields, and it has. But I just think that they're running ahead of the curve. And that doesn't mean that we're not going to see yields ultimately go higher down the road at some point. I just think that we're seeing things move very quickly. Basically, in a little over a month, the 2-year's up 90 basis points. That's an unbelievable move. And the Fed has raised the Fed funds rate 25 basis points. Yeah. That shows, I think, how offside Wall Street was in terms of what it was expecting versus what the Fed has been saying they were going to do. And the only thing that convinced the Wall Street that, oh my God, the Fed really is going to do that is because the data came in, pretty hot and heavy.
Right. And now the market's obviously reflecting that. But what's the next chart? You have the 30-year yield. Okay. So what do you make of this? You talked a lot about the divergences between the 10 and the 30. Yeah.
Well, you did confirm. I thought there was a good chance. We showed the Treasury Move Index last week, and it was kind of like, hey, this is saying yields are going higher. And my expectation in the Monday weekly technical review, I thought, okay, I think we're going to see the 30-year pop over 4%. And if it does, it needs to come right back down below 4%, ideally below 3.99 very quickly. It's kind of like head fake, and then come down. So today, I think that the 30 years down, I don't know, 8-10 basis points, 393 or something, 394-ish. So far, everything is like copacetic. And so from a pattern standpoint, my thought was, and again, back in December, I was looking for yields to go higher. And then in early February, same thing. We talked about all this stuff. I think that it could be an ABC up and that there's another leg down with Treasury yields coming down to at least approach the recent lows. So it's first things first. Yesterday, I sent out a special update saying it was time to buy TLT because of this price pattern. And fundamentally, my expectation is that, hey, the employment report's not going to be 500,000 again and so forth. So this maybe makes it a little bit easier to see on TLT. 1, 2, 3. And then that low we saw in October, to me, was wave 3. I was looking for yields to come down. They did. TLT rallied. And then I just think we've done an ABC to the low intraday low yesterday. And that wave 4 is also tracing out an ABC. A up, the choppy period that we've seen to lows. You can see it also here. So my expectation was we would see TLT drop below 99.35 to complete this sideways correction from the 109.68 high back in early December. And, that's why yesterday I thought, okay, it's time to buy TLT and we'll see what happens. So far, so good.
Well, Jim, I'm going to root you on just because talking my own book. I'm short some dollar yen, so I hope yields do come down because your play here will help my position. So just I'm rooting for you, pal. I'm rooting for you just because of the strong correlation between U.S. yields and the dollar yen. Anyway, okay. So you are seeing you basically think that yields have peaked near term and they're going to come off some.
Yeah, so basically it was buy TLT under 99.35. Okay. Given the pop that we've seen, now I can raise the stop up to break even, basically. Because I don't think we should go back down there again if this is right.
So if this is what you're saying, if this is right, we should not see those levels again.
I don't think so. Because, hey, again, is there a risk we're going that longer term chart, the one before on TLT, ultimately it says, hey, yields are going to take out the highs we saw last October, ultimately. That's what, because that was like wave 3. Yeah. This is all figuring out wave 4. And then at some point in time, wave 5 brings treasury yields to, higher highs. So what does that mean for the dollar? Because I'm now, again, I'm trading the dollar yen. It's usually a little bit more of its own vehicle when you talk about the entire dollar index. But what are you making about with the dollar index as a whole? Okay, so back on February 1st, when Powell was talking, I said it's time to buy the dollar. And that worked okay. The dollar was at 101.05. UUP, which was the ETF, was, I think, 27.24, something like that. And then on that PCE news last week, and you got that big spike right there. It's like I said, sell on the opening. And that was right around 105.20. It just, to me, looks like there's one more drive coming here, Blake, that takes the dollar above 105.35. That was the intraday high. And then we'll get a pullback. So to me, again, this is all kind of predicated on we're going to get some economic news that downshifts people's thinking that the Fed will do 0.5 or might do 0.5. But no, they're only going to do 25 basis points. Because that shift in thinking and what we've seen in the 2-year is what's helped, I think, the dollar rally. And I just think people have gotten overdone on that. That should lead to a pullback in the dollar. But I think the dollar has another push coming after whatever pullback we see.
All right.
But it's like a window is going to get created here that may last 2 weeks.
Got it. Okay.
As we've seen, markets move pretty dynamically when, an expectation is proved wrong.
Sure. So we have gold here, and I'm sure the gold bugs want to hear. They don't want to get squished. They want to hear something good from you, Jim. So what do you make about this move? Because we've had a nice sell off in gold over the course of the last month. You've seen gold really come under pressure. Yeah. And but it looks like we're trying to form some sort of bottom down here. What are your thoughts?
Well, again, gold declined. The dollar bottomed February 1st. Gold topped February 2nd. And I think the odds are, if I'm right about the dollar play coming off after another little bit of a strength, that gold might have a dip early next week if the dollar follows through to the upside. My guess is that gold is going to retrace at least 618 of the decline, which gets it to 1875, 1900 area. I'm not convinced that the correction in gold is completely over. So in other words, the low we've seen in the last week might be wave A. I'm talking about a pop for a wave B, and then there's a C wave coming down again. But, we're talking near term. And I think if I'm right about expectations are going to downshift from a 50 basis point hike to, oh, no, the Fed's only doing 25. You can get a nice pop over the next 2 weeks going into the Fed meeting on the 22nd.
Yeah. That's that would be great. Yeah. We do have the Fed meeting. Next week we do still have jobs report. We also have the Humphrey Hawkins testimony next week as well, right? Yeah. And the CPI report comes out, I think, on the 14th, maybe something like that. Okay. So there's enough data points. The key comes in is that they reverse the negativity that we saw from the January data. Like, oh my God, 500,000 jobs.
That's not, that was due to revisions. And I'm not saying the revisions were, wrong or anything. I'm not trying to cast aspersion, but that's what happened. Once a year they do a revision and they adjust all the numbers, and bingo, it happened in January. I think it accounted for almost 400,000 of the 500,000 increase.
Well, let's talk about let's talk about the S&P. So ultimately, what does it mean for stocks? I mean,
we've been talking, and my expectation is that somehow, some way, we're going to try to see the S&P rally over 41.95. I actually was hoping that we would see the 200-day average get taken out, just because it would cause some additional selling, get the market a little bit more oversold. They played the last 2 days, they bounced above and below.
There's somewhere right there, right?
Yeah, I think it was 39.40, so that red line shows obviously some intraday highs going back the last week or so ago. I think, again, you may see, if the dollar follows through, you might get a little bit of a pullback, but I think as long as we hold above 38.85, that 41.95 is going to get taken out. And again, in my view, that is going to be, whether it's 41.96 or 42.50, I have no idea. But I think that next high, Blake, is going to be another really good selling opportunity and set up potentially a short trade, because I think at sometime later in this year, the S&P is going back down to the October lows.
Wow. Well, that'll be something, because right now a lot of people are pretty bulled up, and they think that the markets are going a lot higher. So it's going to be really interesting to see, Jim, especially if we trade down towards those lows this year. It's going to catch a lot of people off guard.
Well, and that's classic. Again, last summer, oh my God, we're going into recession. And then coming into this year, what was the expectation? Well, we'll be weak in the first half and then strong in the second half, because the Fed will then finally be able to cut rates. Well, everything got flipped on its head. So the street was completely wrong. And I think, again, the idea of no landing, has really kind of taken hold. So that just means that the disappointment will be greater if indeed I'm right and we see, a real weakness build as we get towards mid-year and beyond.
Well, Jim,
oh my God.
Yeah. Well, nothing more warmed my heart this week when I saw you with the update this week about TLT. And it came into my inbox because it really confirmed my thinking with being short dollar yen. So how do other people, other traders, get your information right to their inbox too?
Well, if they're really smart, they subscribe to MacroTides by going to macrotides.com. And if they would like, I just finished the March MacroTides. It's pretty comprehensive. I went through a lot of stuff this last, in the March issue. Send me an email, Jim Welsh Macro, and I'll send you the March issue of MacroTides.
That's Jim Welsh Macro at Gmail, for those of you that didn't catch the tail end of that. Jim, I want to thank you every week I do thank you every week, but I want to thank you for spending your time with us every week. And make sure you give Jim a big thumbs up. Subscribe to the channel down below so you don't miss any of this exclusive content that we have with Mr. Jim Welsh from MacroTides. And if you have any comments, jump in the comment section too. I'm sure Jim would love to converse with you down there.
As long as they're nice comments, Blake.
Yeah, you can do a little bit of that. It's fine. All right, Jim. So thank you so much for spending time with us. We'll see you next week.
You got it, Blake. Thank you.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.